Welcome to Bloomberg BusinessWeek. I'm Carol Massar inside Bloomberg headquarters in New York. This week, political troubles on both sides of the Atlantic. A formal impeachment inquiry is open on President Trump.
Therefore, today, I'm announcing the House of Representatives moving forward with an official impeachment inquiry.
Plus, a defiant Boris Johnson dragged back to Parliament to explain why he broke the law. We take a look at what a hard Brexit might look like. Brexit and President Trump's political future among the topics front and center at Bloomberg's third annual Global Business Forum in New York, a public-private gathering of hundreds of government and business leaders.
When you add it together, I think what it leads to is not a recession, but a slowdown in growth globally, which is what we're experiencing.
More on that ahead. First up, here's editor Joel Weber on this week's issue and cover story, McDonald's in the age of code. Great story. Deep dive into the company.
Yeah, so this is one of the hallmarks of Business Week, I think, which are these strategy stories that we sometimes do. And it's a real look at how McDonald's has been thriving for the past 5 years or so. Share price keeps going up under CEO Steve Easterbrook. And of late, in the past 6 months, he's really doubled down on tech.
And that's what I didn't realize. I mean, Joel, he's made a bunch of acquisitions in AI, in voice recognition technology.
That's right. And just earlier this month was his latest. So what we're seeing really is McDonald's transition from being a fast food company to looking more and more like a tech company. So that there are cameras at drive-thru that can scan your license plate and maybe remember what you ordered last time or understand your voice and help translate that to the kitchen. So we're seeing a real transformational effort to streamline how McDonald's can use technology. But there's always some resistance to that because the business model for McDonald's
to do this, right?
It's very expensive, and the franchisees, which is really the traditional business model for McDonald's, have been pushing back.
I gotta say, what I love about these stories is you get kind of some inside details. They take us to the old headquarters. It was kind of drab, kind of boring. It flooded a little bit. They've got to do headquarters too.
So, and that's in part to try and retain and enlist technology talent that wouldn't have ever looked at McDonald's before. I think my favorite anecdote personally was this story about how the company transitioned to being able to do delivery. And it wasn't like we'll get there in 2 years or next year. It's like, let's do this right now.
Well, you could see the CEO after finding, wait, Burger King can do this?
Yeah,
we're
doing
gonna do this.
Yeah.
Exactly. It's another great read.
And at scale.
And let's not forget, Joel, I mean, this is a company, maybe we take it for granted, it's been around for a long time, but it is a huge company.
Massively global, right? And they feed on any given day 1% of the world's population. So in a time of kale salad bowls and fried chicken sandwiches, McDonald's actually has a new secret sauce, and that's big data.
All right, well, another great cover story. Joel, thank you so much. Joel Weber, editor of the magazine. From big data to a big issue this week, Democrats launch a formal impeachment inquiry of President Trump over his conversation with the Ukrainian president to investigate Democratic frontrunner Joe Biden. Here's Ryan Teague Beckwith in D.C. So, Ryan, what a week in terms of news out of Washington. A lot of press conferences. We've got hearings. We've got a release of the transcript of that phone call. Where are we in terms of this process?
Well, this has been really amazing. If the Mueller report was just a very slow-moving drip of information, this has been a deluge. It's like sweeps week version of the Russia scandal. Very fast. There's the progress from hearing about this scandal to seeing the transcript of the phone conversation with the Ukrainian president to reading the whistleblower complaint in literally could be measured in hours compared to how long it took to find out some of the information about the previous investigation.
Right. The rapidity of all of this coming out really, I think, just blew all of us away. My question is, so what's at stake for the Republicans? What's at stake for the Democrats? What's obviously, we know, at stake for President Trump?
You know, I talked to some people who were involved in the impeachment inquiry into President Nixon and the impeachment of President Bill Clinton, and both Republicans and Democrats, and they both said, at the end of the day, you have to put the politics aside. If the majority of the House believes that the president has committed an impeachable offense, then they have to do it. I think a big factor here was that a lot of the more vulnerable House Democrats who were maybe in their first terms in districts that had been won back from Trump finally came forward and said, we think this is over the line, especially those who had a background in national security and intelligence.
What are we hearing from the White House at this point about it? Because I do think the press conference on Wednesday of this past week, a big press conference, with the UN General Assembly, President Trump's been in town a lot. I think it's safe to say that we all observed a very much more subdued President Trump.
His speech to the United Nations was, but the text of his speech to the United Nations was very militant, but the delivery was very subdued. I think that you're seeing some of the same tactics that he's used to push back against the previous scandals, basically arguing that he did nothing wrong, that anyone would do what he did. But what we saw here was a little bit faster cooperation once the impeachment word was raised with handing over the primary documents. I think that the White House had been stonewalling Congress for a long time on even sort of routine information that past presidents would have given. But once the impeachment word was dropped, they quickly cooperated.
Ryan, thank you so much. Really appreciate your insight. Ryan Teague Beckwith in D.C. Well, coming up, what a no-deal Brexit might look like, plus business leaders weighing in on navigating global instability at Bloomberg's Global Business Forum. This is Bloomberg BusinessWeek. Welcome back to Bloomberg BusinessWeek. I'm Carol Massar. Join us for Bloomberg BusinessWeek every day on the radio starting at 2 p.m. Wall Street time. You can also catch up on our daily show by listening to our podcast. Find that on Apple Podcasts, SoundCloud, and of course at Bloomberg.com. You can also find us online at businessweek.com and on our mobile app. This week, UK Prime Minister Boris Johnson cut his visit to the United States short, returning home to face Parliament and the never-ending Brexit story. Here's Joe Mays in London on what a hard Brexit might look like.
We tried to set out what that first 24 hours might look like if it is the case we end up in a no-deal Brexit. And remember, this is what Boris Johnson is promising to do if he can't get a deal with Brussels. He has said the UK will leave the EU on October 31st. So we've kind of taken him at his word here and said, OK, well, if that were to happen, what would happen next? And so we have followed various individuals who'd find themselves in fairly dramatic situations if it were to be the case that there was a no-deal Brexit. So, for example, we follow a lorry driver going through the port of Dover down to Calais and then to Paris to make a time-critical delivery. We follow a farmer on the Irish border who suddenly has to cope with that change in Ireland, and we follow a musician who's about to go on tour in Europe. So all these individuals who could face pretty meaningful and significant disruption if a no-deal Brexit were to occur.
Well, and let's talk about the ports in particular, because that's really questionable. I think everybody's wondering, if we do have a hard Brexit, how do they operate? The port of Dover, we're talking about the Channel crossing. There was a stat in there that you said 10,000 trucks go through the ferries every day at these ports, carrying almost 1/6 of all trade and goods to the European Union. I mean, this is huge.
Exactly. It's probably the most important crunch point for Britain when it comes to trade, and it's the area where the government is really keen to make sure there isn't disruption. But as we talk about in our story, there is a certain limitation on what the British government can do to keep that traffic flowing, because the British can't control what the French will do. What will the French customs officials do when those trucks start coming over in a no-deal Brexit scenario? And I think the fear the government has is that the French government will be quite strict in its application of the rules, and that will mean that trucks end up being pulled over if they don't have the right documentation. And remember, they will need new documentation in a no-deal Brexit scenario, because the UK will no longer be in the EU, we'll have no agreement, and we need all these extra customs forms. So that's the worry, and that's where the disruption could occur, as we talk about in the story.
Let's talk about that farmer at the Irish border, because I think it's fascinating that as he's dealing with his herd, he could be kind of, in violation, not in violation, in violation. Explain that.
So the thing to know about the Irish border is that it's not a straight line, and the Irish border is a real kind of squiggle, and therefore you have individuals who have farmland on both sides, and just to cross their farm they might end up crossing the Irish border on several occasions. And that's the case for Jas McDonald, the farmer we talk about in our story. And so the problem that he faces is that if he has sheep in Northern Ireland and he wants to move them, say, 100 yards down the road to another field, he would have to cross into the Republic of Ireland, and in a no-deal Brexit that would be illegal. That would be smuggling. He would have to go through a customs checkpoint to declare these animals, because the rules say if you're moving livestock into the EU from a non-EU country, you must have it checked. So that's the kind of issue that he would face on the first day of a no-deal Brexit. Obviously, it's an open question as to whether the Irish government would actually physically install those checkpoints on the Irish border. Clearly a very politically sensitive issue.
What's kind of our takeaway, our bigger, broader takeaway here? Because it sounds like initially it isn't a doomsday scenario.
Don't necessarily expect significant visible disruption on the first day of a no-deal Brexit. I think many of the impacts that have been talked about that could occur, if they do occur, they would happen in the days and weeks after. It would take some time for the disruption to flow through. And that's mainly because if there is to be disruption at the ports and trucks get held up and so on, it would at least be 2-3 days, a week after, before the rest of the supply chain feels that effects. But also, people have built stockpiles. So companies have stockpiled goods. They can run those stockpiles down, which will see them through the first few days and weeks. It's then, they would start to feel some pain if that disruption has continued.
Staying with politics, President Trump using his speech at the United Nations this week to reiterate complaints about China's trade practices.
But as I have made very clear, I will not accept a bad deal for the American people.
Deal or no deal, the expanding global trade war is already hitting close to home. Let's bring in reporter Sean Donnan. He follows trade and globalization for us here at Bloomberg. He joins us from D.C. Sean, great to have you here. Your story this week in the magazine, I feel like we need to get ready for maybe, is it trade war number 3? It's expanding in terms of concerns about trade with Europe.
Absolutely. So we're getting ready for the next front, and that's going to really start to unfurl in the coming days as the Trump administration starts to roll out new tariffs on the EU. And those are the result in the first wave that we're going to see of a long-running battle between Airbus and Boeing that has been fought at the World Trade Organization. We're expecting the WTO to authorize the U.S. to levy something like $8 billion in tariffs on the EU, and that is going to hit the EU hard. But it's also going to blow back here in the U.S. There are some states like Alabama that have some pretty close ties with not only the EU and European businesses more broadly, but Airbus pretty directly.
Yeah, it's a big deal. And certainly you talk about the European direct foreign investment into the state of Alabama. The biggest one is from the EU, correct?
Absolutely. They are the biggest investors in a number of states, including Alabama. There's 2 big factories that we think about when we think about the European presence in Alabama. Down in Mobile, there is an Airbus plant where they now assemble A320 planes, and they're going to start assembling A220 planes. And then up near Tuscaloosa, there's a big Mercedes plant that's been there since the 1990s. There's something like 8,000 people that go through the gates there every day. They turn out 245,000 vehicles a year, including a lot of those new Mercedes SUVs you see on the street. And a lot of those SUVs actually get exported from from Alabama to places like China.
Well, global trade was talked about a lot at Bloomberg's Global Business Forum, a public-private gathering alongside the United Nations General Assembly this week, convening heads of state and government and hundreds of CEOs in New York. We spoke with Anand Mahindra, Chairman Mahindra Group, Steve Schwartzman, CEO of Blackstone, and Brian Moynihan, CEO of Bank of America, on the U.S.-China trade war.
What you've been seeing over the last 2.5 years is the U.S. wanting them, as sort of the leader of the developed world, to come pretty far. And on the Chinese side, they're trying to figure out how far and how fast they want to get someplace. So the 2 countries got quite close in May, at which point the Chinese just withdrew. They had agreed to a variety of things, we thought. And then they looked at the whole and they said, my goodness, let's not do that. And now this is starting again. And meanwhile, what's happened in this 2.5 years is that the 2 countries have started, as a result of false starts and a variety of other tactical stuff, are starting to decouple, which is very dangerous.
I want to dig a little bit into that, because I do wonder, I think increasingly we're expecting this world where it's China and its allies and the United States and its allies. And you sit in a very interesting place, figuratively and literally, between China and the United States. How do you see it?
I see it as a situation of enormous opportunity. I have to be mercenary about that.
You mean the spat you do?
Of course, absolutely, because and I'm just being truthful here, that for a long time it wasn't kosher for anyone in American policy positions to admit that there was a kind of conflict with China and that India, in fact, could be one of the players in this game as a buffer against China. That was just a no-no. If you went to the Council on Foreign Relations, nobody would admit that. I think now it's in the open. And I think President Trump has even made it more in the open. I mean, going to Houston and listening to our Prime Minister, I think he made it very clear what kind of alliance he had. I think there's nothing but opportunity for India in this. And we have to play our cards right and see that we are viewed now as a very, very appropriate ally for the US, as a buffer both in defense terms, frankly. If you look at the number of defense exercises between the US and India, they're proliferating dramatically. Defense procurement from India is already burgeoning. We never used to buy, we used to buy more from the Russians. And frankly, all the tenor of the relationship with India is right. This is a democratic country. It's a country that values IPR. This is a country that has scale and growth, so there is profit for global companies too over there. So I think India has nothing but a unique opportunity right now, and we have to just play those cards right. And I think it'll be a win-win for both the US and for India.
So I actually agree, and having been with a bunch of CEOs with the Prime Minister this morning, all who are talking about their business expanding in India, it's been a natural recipient, and I think some of the bureaucracy and things that were difficult to operate have been dealt with. They can be improved, and everybody knows. I think the broader context here, though, is global trade, and if you go back and say if the China-U.S. situation will take longer, the question is what can we resolve in the interim, and this is where, unfortunately, I'm not sure what happens given the politics and the situation this week to the USMCA and things like that, which are critical to get done, because as much as India is a beneficiary, Mexico and Canada in a trade with the U.S. is a beneficiary in a sense, or a way to operate. Let's make it simpler. The wage scale in Mexico is actually lower than parts of China. They could use the jobs. There's a lot of people who could move the manufacturing there. There's already integrated manufacturing supply chains. Canada's a different situation. So I think to keep the U.S. kind of moving forward, there are 3 or 4 things to knock out. Everybody hopes for China, U.S., but there are a couple things to knock out first, and one of them is a USMCA. I just don't know politically if they can push it through, even though I think both sides seem to want it. And if they could push that through, that would be good, and give more time to work, I think, on China.
You can hear more of that conversation from the Bloomberg Global Business Forum on this week's Extra podcast. Up next, SoftBank has a problem, WeWork. Plus, loving it, meaning IT, McDonald's in the age of code. This is Bloomberg BusinessWeek. Welcome back to Bloomberg BusinessWeek. I'm Carol Massar. You can also listen to us on the radio on SiriusXM Channel 119 and on AM 1130 in New York, 106.1 in Boston, 99.1 FM in Washington, D.C., AM 960 in the Bay Area, in London on DAB Digital, and on the Bloomberg Business app. Another big story this week, WeWork's plan to go public hit a wall. Adam Neumann, who co-founded WeWork, turned it into one of the world's most valuable startups. Well, he stepped down as CEO under pressure from his board. This week's technology section looks at one of WeWork's biggest investors. We're talking about SoftBank. Editor Rebecca Penty joining us now. So, Rebecca, I think the question is right now, as we've seen this reduced valuation of WeWork, the We company, as it's now known, will SoftBank's founder, Masayoshi Son, have to kind of reduce his valuation and really write down this investment?
That's right. So we're hitting the end of the quarter, end of September, and throughout recent months, banks have taken down their estimates of what WeWork is worth. You know, we were hearing estimates of $65 billion or more. SoftBank, in its latest investment round, got in at $47 billion valuation. Now it looks like WeWork could be worth $15 billion or less. So how does SoftBank handle that? Do they take a big write-down? That's the big question.
Well, and the other thing is, and you pointed out, or the story points it out, is that he is very quick, the Vision Fund, very quick to write up a valuation. So will they be as quick to write it down?
Yeah, that's right. It calls into question the whole fair value accounting for private equity, because there's a lot of leeway in how they account for things. Masayoshi Son could argue that, look, WeWork is still just as successful as it has always been. Just because investors on Wall Street are debating the value ahead of an IPO,
right?
Look, they're still bringing in the same amount of revenue that they were bringing in when we last got in. So he may not actually have to do it. But if you want to think about, do people have faith in SoftBank?
Well, I think that's the big issue, right? Because you think about the Vision Fund, SoftBank's Vision Fund, incredible amount of money investing in technology. Uber was one of their main investments. That valuation has come down.
That's right.
Same thing with WeWork, that you do wonder what faith will future investors have if you're not kind of rethinking the valuation of the fund.
Yeah, that's right. And consider that these big investments have been driving the Vision Fund. So
right.
it been driving SoftBank's profits. It's not the old school telecommunication businesses. So there's a lot riding on his big bets on tech companies.
But he doesn't have to write it down, right? Technically, he doesn't have to.
That's right. So it's a giant question mark, and as we've seen, Massason's tone around WeWork has changed in the last few weeks. I mean, SoftBank was a key reason why Adam Neumann stepped down, as we've reported. They were pushing for him to step down. And in recent days, we've seen a shift in approach by Massason.
Well, I do also wonder, we've talked so much about the Vision Fund and the influence that it's having really on the investment community because they can make such big investments. Because typically, like in an investment fund, some investments will pay off, some will not. But we're really looking at it very differently.
Yeah, that's right. And I think the other thing that's come out is Massason's, leeway for founders to behave in very sort of radical ways, this Silicon Valley approach. And I think we're seeing, we had a report that that's changing, and he's starting to send out this message that, hey, look, you're going to have to be profitable sooner if you want my money.
Yeah, I feel like this week, there was a lot of news going on in general, but I feel like everything surrounding WeWork, we've really started to rethink IPOs and startup companies, how we look at them, and really accountability.
Yeah, that's right.
All right, gonna leave it there. Rebecca, thank you so much. Editor Rebecca Penty. So also front and center this week, climate change as heads of state gathered in New York, along with some of the world's top corporate leaders at a United Nations climate summit. And as concern mounts, this week's business section looks at how companies are addressing their travel policies due to something called flying shame. Yep, it's a real thing. Here's this week's Business Week explainer.
By plane, it's 90 minutes from Stockholm to Berlin. But when Swedish finance startup Klarna celebrated going public by having a party in the German capital, 600 staffers took the train. 13 hours, which included 3 changes. It wasn't a one-time thing. Klarna bans virtually all employee air travel within Europe, and it discourages longer distance flights. The goal? To become carbon neutral. The Swedes, they have a name for it, flygskam, which means flying shame, and they're not alone. Companies and non-governmental organizations across Europe are taking a hard look at their travel policies. Sweden-based airline SAS says traffic fell 2% in the 9 months that ended in July. Sweden's airport operator says domestic flights have carried 9% fewer passengers this year than last. Both blame flygskam, and there's not much airlines can do to push back. For a jet, the carbon dioxide output per passenger mile is at least 4 times that of trains. European airlines have the most to lose. They fly a lot of short flights, and across the continent, high-speed rail is a viable alternative.
Coming up, in an age of kale and faux meat, McDonald's has a new secret sauce. And burgers to beer, we hear from AB InBev CEO Carlos Brito. This is Bloomberg BusinessWeek. Welcome back back to Bloomberg BusinessWeek. I'm Carol Massar, inside Bloomberg headquarters in New York. Still ahead, Blackstone's Jonathan Gray on where he's deploying capital, plus Brookfield Asset Management CEO Bruce Flatt on business since Brexit. All of that to come from Bloomberg's Global Business Forum. We begin, though, with our cover story. McDonald's CEO Steve Easterbrook wants Big Macs to keep up with big tech.
In 1948, McDonald's had its first big technological breakthrough. It offered a simple menu of hamburgers and soft drinks, all produced quickly and cheaply on a custom assembly line. This innovation helped spark the $600 billion modern fast food industry and one of the most iconic brands of all time. In 2013, earnings began to stagnate as diners deserted the Golden Arches for new burger upstarts. 2 years later, Steve Easterbrook came on as CEO to help reverse course by pushing McDonald's to take its next big tech leap. So far, his plan seems to be working. At some locations, orders placed on the McDonald's app are automatically prepared the moment a customer comes within 300 feet of a store. Over in the drive-thru lane, the company is testing technology that can scan your license plate and suggest food based on previous orders or shape the menu based on the day's weather. From touchscreen kiosks inside the stores, diners can customize their burgers into thousands of different variants. McDonald's is adopting the approach of Amazon, Facebook, and Google by using technology to personalize the consumer experience. Powered by this data, it's not crazy to expect that McDonald's will someday know that you want a Big Mac without onions, large fries, and an Oreo McFlurry, even before you do.
And staying with our cover on McDonald's, we now head to the reporter behind the story, Thomas Buckley in London, who looks into whether big data is the secret sauce.
Steve Easterbrook, the current CEO who's made technology the focus of his tenure at the company, he was traveling in Spain and realized that Burger King was offering delivery to the Spanish market. And on the nights when Spanish football teams or soccer teams were competing in the local league, McDonald's was losing a lot of customers to Burger King on account of that.
So let's talk about what McDonald's has done to be much more digital.
Our current corporate culture, calling yourself a technology company, is a bit of a throwaway line. I think that everybody, left, right, and center in every industry is trying to do it. In McDonald's case, there's something very tangible about the efforts that they're pursuing. So, for example, they've acquired, this was back in March, Dynamic Yield, which is a Tel Aviv and New York-based artificial intelligence startup. That was for $300 million. That was their largest deal in about 2 decades. And the purpose of that really serves to suit Easterbrook's vision, which is to eventually have cars' license plates scanned to recall previous purchases at the drive-thrus. It's going to suggest items based on similar purchases at similar locations and the weather and all sorts of other variables that really allow McDonald's to process a lot of data and gauge what's best to sell at any given time.
They're also, though, redesigning stores as well, right? They're kind of thinking their physical outlets.
Absolutely. So this is an initiative that Easterbrook had been shepherding just before he became CEO in March 2015. It's called Experience of the Future, and it's requiring the franchisees who own and operate about, over 90% of McDonald's stores globally to completely imagine the function of the store and the services that it offers. Now, the cost of remodeling those is between, I think, $160,000 and $750,000 for the more comprehensive remodels. So naturally, the owners and operators who are having to fork out quite a bit of cash to see these through are protesting the vision somewhat.
I mean, Thomas, McDonald's didn't really have a choice, right? Because in the face of increasing competition, there's lots of burger joints out there. There's also trends that are in food trends specifically, are changing, right, in terms of plant-based alternatives. People are interested in that. And McDonald's, I mean, they're huge, no doubt about it, but they were seeing their growth slow down and market share maybe also pull back.
That's absolutely right. I think that it's one of those classic examples of a deeply, deeply iconic American brand that was really fueled by baby boomer loyalty for a very long time and rested on its laurels somewhat, had undeniably lost its way with the customer. And I think that Easterbrook had been probably on the sidelines for a lot of his career at McDonald's. I mean, he spent 17 years in the business and thought, this is how we ought to change things for the better. He was head of the UK, he was head of Europe, and he was observing all of these different trends towards organic, towards healthier fare, and thought maybe we can bring some of that innovation to McDonald's, not necessarily on the health side, but perhaps more on the technology side.
I'm here with Kaylee Lyons. She's got more on if McDonald's CEO Steve Easterbrook's strategy is working, right? Because we want to see if there's results.
Yeah, and the results actually are looking pretty good when you think about the key metric for restaurant change, and of course that is same-store sales. This is looking at McDonald's same-store sales growth, which are the white bars, compared with Yum Brands, the second largest restaurant in terms of sales after McDonald's, which are the blue bars. Now, if we take it back to 2014, you can see that McDonald's sales were not doing so well. Easterbrook took the helm back in March of 2015, and you can see since then the trend really has reversed. Sales have been accelerating, and while the pace of growth has ebbed and flowed a little bit, it has been growth nonetheless, especially in the most recent quarter in which same-store sales grew 6.5%, which was the best since back in 2012. And of course, as you can see on this chart, they also have been outpacing their competitors. So that would suggest, Carol, that he does have the secret sauce.
Yeah, quite a big turnaround. Kaylee, thank you so much. Kaylee Lyons. So from burgers to beer we go. We go back, in fact, to Bloomberg's Global Business Forum, where my co-host Jason Kelly caught up with Carlos Brito, the chairman and CEO of AB InBev.
In general, because we're a global business, we see a good environment for our business. It's not without challenges, but that's always the case. So we don't see that what we read sometimes in papers. The other thing is that our production is very much localized.
Right.
So a lot of these things about restrictions, about trade, about flow of goods, that doesn't really necessarily affect us. Always affects a little bit, but 95% of what we produce, we source locally, we brew locally, we sell locally. So it's a bit different.
Right.
So we're brewers, so we're always paying attention to what's happening to our consumer. We're not economists, so I don't have an opinion on some of these trade conversations. But if it's good for our consumers, we're happy.
Let's talk about Asia. You pulled off an IPO there after one false start. You got it out, second biggest IPO outside of Uber, only behind Uber this year. What does that tell you about that market, and what does it tell us about the strategy going forward?
Well, our business in Asia is an amazing business. We're the number one brewer, especially in the premium segment in Asia overall. In China, we're the number 3 in volume, but number 1 in profitability by a wide margin, and that's because of the premium brands we sell that command a premium and higher margins. So the idea of the IPO has always been to establish and to create a local champion that could be a vehicle for other consolidations and other things we could do in Southeast Asia, mainly. And that's done now. It's in the process. Shares will start trading next Monday, the 30th. And yeah, so very happy to be where we are.
And so is that a playbook that you might use in other places around the world, say in Africa, maybe, the sort of model that you set out in Asia, or is this a different sort of thing?
No, that's very much a mirror of what we have in Latin America.
Right.
What we had in Latin America for many years, in which we had a local champion, InBev, that's listed, controlled by us. And InBev was an amazing vehicle to talk and get to deals with local families in different countries and really expand within the region. We think that same magic could happen now in Asia.
Okay. And when you think about, part of the reason to do this deal was to pay down some debt, how far along are you in that process, and what are some other moves you might consider to keep on that track?
Well, the main reason for the IPO was really to create a local champion, because as we said from day one, we don't need that to get to our target of being net debt to EBITDA below 4 times by the end of next year, 2020. But we felt we needed a local champion there to mirror what we have in Latin America. But of course, the proceeds that we're getting, $5 to $5+ billion, will be used, of course, to pay down debt, as with the proceeds that will come from the Australia sale, around $11 billion.
Got it. You think about the cannabis market. You and I have been talking about this for a couple years now. Tell me where you are in sort of testing that out. You've got a relationship, I believe, with Tilray.
Tilray, yeah.
How is that going? What do we expect to see next?
Well, to this day, what we have is this. We have a relationship, a joint venture with Tilray in Canada, and for Canada only, because that's where it's legal. At this point, we're only doing R&D. We're not commercializing anything. We haven't made a decision to commercialize anything. So we're only trying to solve some issues in terms of beverages, non-alcohol beverages, infused mainly with CBD that we're studying. But we haven't made a decision yet to go to commercialization.
Still ahead, Blackstone's Jonathan Gray on his 3 threes to measure economic growth, plus Bruce Flatt on Brookfield's $5 billion Oaktree deal. This is Bloomberg BusinessWeek. Welcome back to Bloomberg BusinessWeek. I'm Carol Massar. Join us for Bloomberg BusinessWeek every day on the radio starting at 2 p.m. Wall Street time. You can also catch up on our daily show by listening to our podcast at Apple Podcasts, SoundCloud, and at Bloomberg.com. You can also find us online at businessweek.com and on our mobile app. We return now to Bloomberg's Global Business Forum. Here's Jason with Blackstone's Jonathan Gray on navigating economic uncertainty.
You've got some uncertainty in the world. You certainly have some friction from the China trade. You've got the Brexit situation, and you just have some geopolitical concerns that are making everybody nervous. Businesses are responding by pulling back a bit. You see that in manufacturing, industrial data, capital investment, and you're beginning to see that in earnings from companies. So that's one side of the equation. On the other side of the equation, the consumer is actually doing pretty well around the world, particularly here in the US. So I was talking to a friend this morning about what I think of as the 3 threes, which are, we have 3.7% unemployment, wages are growing north of 3%, and home prices are growing north of 3%. So if you think about the consumer, they have a job, wages are going up, and their biggest assets appreciating in value. And that's why you see this bifurcation. So I'd say when you add it together, I think what it leads to is not a recession, but a slowdown in growth globally, which is what we're experiencing.
And so how much does it slow down and when? Are we in that now?
I think we're in that now. It's hard to say. The good news is central banks have decided, that they're going to lower rates and continue to stimulate, which has helped soften the blow a bit. And it's possible that some of these issues, like China trade or Brexit, get resolved, which would take a little bit of this uncertainty away. I think as investors, though, you don't want to get too caught up in sort of the heat of the moment. You want to try to take a longer-term view.
So where are you spending money? I know your investors are asking you that every time they get on the phone with you. Where are you deploying capital? You got $500+ billion in assets.
Well, that is the big question. I think in this point in the economy, where you have slow growth, you also have pretty high multiples, right? The low rate of interest rates, it's created expanded multiples. So you have to be cautious on where you invest. What we're looking at are places where technology is creating a lot of change and where they're really in the path of growth, industries in the path of growth. So globally in logistics, we've talked about it before, we've been the big buyer of warehouses around the world, probably bought $70 billion on the simple premise that goods are moving from physical retail to online retail. We're doing things around content creation as a result of the cost of distribution of media coming down. You want to service that industry. Software as a solution, things migrating to the cloud. We bought a big business that does things in the human resource area online. India, another area that's benefiting from IT services. So I think as the global economy transforms, even though the overall growth rate isn't that high, trying to find those industries and sectors that have the wind at their back is really important.
So you a net buyer or are you a net seller at this point across all of your empire?
I would say it's a bit of both. I wouldn't say, there's one clear path. I think when we find businesses that have stabilized and sort of our buy it, fix it, sell it approach, we exit. On the other hand, there are plenty of things that we still have conviction in and we hold. So you're seeing us sell, but at the same time deploy a lot of capital. We put out $56 billion of capital in the last 12 months, so we're still finding interesting things. I would say it's more selective, and it tends to be in larger situations.
Right. Jason also caught up with Brookfield's Bruce Flatt at Bloomberg GBF to talk about investing in a time of instability.
Politically, many countries are up in the air and pretty extreme politics in those places. But on the ground in business, actually, it's pretty constructive. Most countries of the world are doing okay. And as value investors, we look for places where you can put money for a long term. You can make decent returns in the fullness of time, and instability sometimes brings opportunity. So you just need to think long term in these situations.
Well, let's talk about those opportunities, because as you say, maybe some of this uncertainty drives valuations down, because valuations have been pretty high, it feels like, for the past couple of years. Are you seeing that yet?
Well, not in the developed markets. Valuations are still high. So our focus is special situations in those places.
Yeah.
But Europe is being driven by interest rates that are really low today. India has a situation where the financial system needs capital, so there's a lot of opportunity there. In China, we're seeing more opportunities because of just the deleveraging going on in the country, and that's a positive, and it creates opportunity.
All right, so you mentioned China. U.S.-China trade, obviously top of mind, continues to be. How does that play through, if at all, into your investments or into your thesis about the world?
So our business is about buying real things, real assets. We buy pipelines, toll roads, real estate, renewable power plants, and they're local investments in every country. So we're in 35 countries in the world, but we're a local investor in every single country. So it's not, trade doesn't really affect. On the margins, it does. If it affects a country's economy, it obviously affects investments. If it hits currencies, it affects your investment as a global investor. But we're an on-the-ground investor, so trade isn't as important to us.
Let's talk about one specific local national situation. That's Brexit. We had Boris Johnson, the UK Prime Minister, leave New York early, the UN General Assembly, to get back. We're going to be hearing from him later on today. You're a big landowner and a big landlord, I should say, there in London. Canary Wharf, obviously, has been a big project. You got a lot invested there. How does that play through?
We do. Business has been good since Brexit happened. Every day that this gets extended and nothing happens, fewer decisions get made, and that's not helpful for business. In the fullness of time, I think just getting something resolved will be a good thing for everyone, and London is going to be a center of commerce for a long time. And we just need a solution to it. That's all.
You're about to combine officially, close the deal with Oaktree. That combination. What should we expect in the near term in terms of the opportunities that presents?
Well, we've announced closing. It's on Monday. We're excited and thrilled to partner with Howard Marks and Bruce Karsh and their team. They're going to run the business. We're going to help them in any way we possibly can. We think it's an added benefit to our institutional clients to offer their products. And in the world we're in, where low rates are pushing money into alternatives, I think our general private equity real estate infrastructure franchise will benefit, and now we have a credit offering to add to that.
Up next, pursuits and how surfing is splashier than ever in the land of the rising sun. This is Bloomberg BusinessWeek. Welcome back to Bloomberg BusinessWeek. I'm Carol Massar. You can also listen to us on the radio on SiriusXM Channel 119 and on AM 1130 in New York, 106.1 in Boston, 99.1 FM in Washington, D.C., AM 960 in the Bay Area, in London on DAB Digital, and on the Bloomberg Business app. We turn now to this week's Pursuits opener. Here's editor Chris Rauser on Japan's surfing sensation.
Our opener is a profile on Kanoa Igarashi, who is the 6th-ranked surfer in the world, and he grew up in Huntington Beach, California, but he's actually going to be surfing for Japan in the 2020 Summer Olympics, which is the first time that surfing is actually an Olympic sport.
And he is a phenomenon in Japan and has launched that sport to popularity that is only really rivaled in the United States. And even on a per capita basis, it sounds like there are more surfers in Japan than the United States.
Yeah, there's about 2 million surfers in Japan, and there's about 126 million people there. And that's percentage-wise more than it is in the United States. And surfing in Japan has been big for a long time. The waves there are very reliable. There's great remote beaches, but he has transcended the fame of surfing. Like he's famous for anybody. He's like movie star famous there.
Well, it's so much fun that you guys detail in the article about kind of like a typical day for him, and he's signing autographs, doing press conferences. Tell us about all the things he's involved in.
Oh yeah, he wakes up in the morning and he's in, he's in California. He's surfing with Kelly Slater. He's doing photo shoots, and he flies to Tokyo, and he's doing another photo shoot all within 24 hours, signing autographs. Like it never ends for him, and he has like a ton of energy. He's a young guy, and he thrives on the fame. Some athletes, don't always love that, right? But this is his thing. He likes it.
And this is a guy who was literally bred to achieve what he has achieved. I mean, this is an amazing story. It is very similar to Richard Williams and his daughters.
Venus and Serena. It's exactly like that. His parents were kind of hippies. They were living in California, and they decided that, their thing was going to be that their kids were going to be incredible surfers, boy or girl. And Kanoa, when he was 7 years old, was out on the water by 5:45 in the morning so that he could, surf for a couple hours and be in school by 7:20 for second grade.
Isn't that amazing? I mean, his parents left Tokyo, right, and went to California to do all this.
They were in California when they had him, and then he's going back to surf for Japan. But a little bit of home field advantage actually, because the beach where they're doing the competition for the Olympics is in Chiba Prefecture, and it's actually a beach where his dad grew up surfing. So he has sort of like really the insider advantage there.
Maybe if he does really well, wins the Olympics, goes out on more endorsements, he can buy this next car, and it's by Ferrari, and it's pretty cool, at least according to Hannah Elliott.
Yes, Hannah Elliott continuing to have the best job of all time.
Totally.
We sent her to Maranello in Italy. She tested out the Ferrari F8 Tributo, which replaces the 488 GTC, which was kind of their like the big sports car that you would see that you'd be like, that's like a hot Ferrari. And it has the same twin turbo V8 engine. It's redesigned. It's lighter. It's faster. And she had a great time zipping around. Her review is that it is an incredible car. It's the most beautiful Ferrari they've made in a decade, and all the other critics agree.
Yeah. Well, and she even goes a level down to just the way that it sounds and makes these comparisons to almost a musical note that it strikes.
Yeah, if you've ever been in a car like that or driven it, it can sound like a ripping noise, kind of like a brap, like it can be not beautiful, although it is a very powerful sound.
Right.
And she said the sound of this car is actually truly beautiful.
All right, so a great book review as well. New book by Bob Iger. It's not really a tell-all because Bob Iger's not that kind of guy, but there's some pretty amazing details in here about his career, not just running Disney for the past 15 years, but how he got there and candidly what he endured in that C-suite.
The book is called The Ride of a Lifetime, Lessons Learned from 15 Years as a CEO of the Walt Disney Company, which sounds like, but actually, no, it is a wild ride. And, he has details about following Michael Eisner. He has like what happened with Ovitz when he came in and how brief that was and what that was like to watch. And then even when he was sort of competing to get the role for himself, how he was treated. And,
by a headhunter.
A headhunter,
oh my God, that story. Don't give it away.
Yeah, okay, you got to read it. But there's he's like basically humiliated by a headhunter. And it's not like he hadn't been at Disney, right. It's not like he wasn't somebody
he's
who
not
was
an
like
unknown commodity.
Right? Yeah, exactly. And then we're dealing with Rupert Murdoch and how the whole Fox deal came down and all the drama behind that. There's a lot of juice in there, and it's fun.
It comes at a time when we feel like some really well-known folks, obviously in the financial community, we've talked to them, and a lot of well-known, I feel like in the business community, are out there writing kind of books about their time, their tenures.
Yeah, and he's not done, right? So
he's
part
not.
of the deal with Fox is he has to stick around, and so they're launching a streaming service, and after all of the stuff that he's accomplished with Pixar and everything like that, this streaming service may be the period at the end of the sentence. If that doesn't work, that's his legacy.
Bloomberg BusinessWeek is available on newsstands now, also online at businessweek.com and on our mobile app. And definitely check out our daily BusinessWeek podcast, available at Apple Podcasts, SoundCloud, and at Bloomberg.com. Lots more highlights from GBF there. More Bloomberg Television starts now.